Good morning, everyone, and welcome to our 2017 year-end tax planning seminar. My name is Troy Turner. I'm a tax partner here at Gelman, Rosenberg Freedman, and I will also be one of the presenters today. We have a lot of material to cover, so I'm just going to go ahead and move through the slides here. First, I want to cover some housekeeping duties. If you have any technical questions or issues during the webinar, please use the chat function to speak with our webinar administrator for assistance. Technical assistance is also available from WebEx at the number shown here. Please note that this webinar will be recorded and made available on our website following the event. This webinar is available for CPE credit. Attendees seeking CPE credit for this presentation must complete and submit a short evaluation survey that will pop up on your screens after the webinar ends. 3 words will be shared during this presentation. The survey will ask you for these 3 words. Attendees cannot claim CPE credit unless we receive a completed evaluation with the correct words. Technical questions about the survey can be addressed to Alina Stone at her email address listed here. Please make sure you turn off your pop-up blocker. Leaving it on could block the survey at the end of the event. This presentation will be available for download at our website listed here. The objective of the webinar is, as stated, to cover 2017 tax planning items and also to update you on the current tax laws that are being bannered about in Congress. And again, you can earn 1 hour of CPE for the webinar. So your presenters today, I've already introduced myself. Also presenting today is David Grayling. He's a audit and tax partner here at the firm and one of our founding partners. Here's a list of the agenda items we're going to cover. So we're going to talk about ways to reduce income in general. We're going to go over itemized deductions, some of the credits that you could potentially take on your tax return. And then lastly, we're going to go over the potential law changes that could be upcoming. So first of all, we're going to cover ways to reduce income. We're going to talk about wages. Generally speaking, there are not a whole lot of ways to reduce your wage income from a taxability standpoint. One of the ways to do that, though, is to contribute some of your earnings to a flexible spending account or a health savings account, otherwise known as an FSA or an HSA. Normally, you would enroll in these plans if your employer offers them at the beginning of the year. There could be a chance you could contribute in those plans now. I would check with your HR department, but chances are, if you haven't already enrolled in your FSA or your HSA, you may not be able to do so for 2017, but it'll be something you would want to look into for 2018. The limit on your FSA account, the amount you could put in there on an annual basis is $2,550, and then you can take those monies out to cover any qualified medical expenses. Otherwise, medical expenses would be an itemized deduction that David will cover later. Your health savings accounts, your HSA, in order to have one of these accounts, you have to be part of a high deductible health insurance plan. The caps on monies you could put into those accounts for a single plan participant is $3,350 for 2017. And if it's a family plan, you could put up to $6,750 in your HSA. And again, those monies go in pre-tax, so the contributions reduce your taxable wages, and then the money you take out of the plan comes out tax-free and is used to cover qualified medical expenses. Also, your employer may offer a dependent care flexible spending account, and this is where if you have dependents that are in daycare, and you can defer up to $5,000 a year into this account. So basically, the amount you put in, again, lowers your taxable wages, and you can take that $5,000 out to cover dependent care costs. And again, most likely you would have had to have enrolled in that plan at the beginning of the year. You may be able to contribute to it before the end of the year, but I would check with your HR department. But if not, you can make sure you look at that for 2018. A big one is retirement plan deferrals. So your 401k or your 403b plan. For people under the age of 50, you can defer up to $18,000 of your wages into your 401k or 403b account. And if you're 50 or older, you can put in an additional $6,000 into that account, so for a total of $24,000. So this is obviously a great way to save for retirement. Lowers your current taxable income with the idea that when you retire, your income overall will be lower when you take money out. So therefore, when those earnings are taxed, they're taxed at a lower rate. And most likely, if you aren't on pace to max out your contributions in these accounts, that you would be able to do so in your last couple of paychecks, or if you're going to get a bonus, it's a good way to shelter some of that bonus income. If your employer reimburses you for employee-related business expenses under an accountable plan, you want to make sure that you follow those plan rules and get your expense forms turned in timely. If you don't follow certain time frames, then you may still get reimbursed, but your employer may have to actually put that reimbursement in taxable wages rather than it being a tax-free reimbursement. So obviously you want to be reimbursed for all your business expenses tax-free, so you don't want to be late in getting those forms in. And lastly, this probably won't apply to most people, but if you're in a position where if you're going to get a bonus at the end of the year and you can defer it to January of 2018, given that there's some uncertainty in the tax law, we may get a new law that would lower rates in your particular bracket. Deferring taxation to 2018 could lower your overall taxes on that bonus. So to the extent you may have some flexibility in the timing of your bonus, you may want to think about delaying it to January. So now we'll talk about ways to reduce tax on investment income. So one way to do that is to invest in tax-free bonds, municipal bonds, local government bonds. The interest that's paid on those is not taxed on your federal return. And generally, if you invest in bonds of your home state, that your home state won't tax that interest either. If you invest in an out-of-state bond, then still tax-free at the federal level, but most likely it will be taxed at you on your home state return. You can invest in stocks that pay qualified dividends. Qualified dividends are taxed at the lower long-term capital gain tax rates, which we'll talk about in a second. So versus if you invest in stocks that maybe mutual funds that invest in bonds, then some of those dividends will be non-qualified and taxed at your ordinary income tax rates. So getting qualified dividend income, and qualified dividend is your Ford, GM, Exxon, Apple. I mean, you're basically, what you think about is getting a dividend from a regular corporation or a mutual fund that invests in stocks like that. You can invest in annuities or life insurance that build up cash value. Basically, the benefit there is not a lower rate of taxation because the income you take out of the annuity or your life insurance later on, to the extent that it is income and not a return of principal, would be taxed at ordinary income. But the income that is generated inside the annuity or the life insurance contract is deferred until you take it out. So that's the benefit there, is you have the deferral. If you're looking to sell some of your portfolio, make sure that the stocks or investments that you're going to sell, you've held them for more than a year, because doing so will qualify the gain on that sale for long-term capital gain tax treatment. And the tax rates on long-term capital gains vary from 0% at the bottom end all the way up to 23.8% at the very highest level when you factor in the net investment tax of 3.8%. So basically, long-term capital gains can be taxed generally at 0, 15, or 20%, and then there's a net investment tax of 3.8% that kicks in when your income's above $200,000 on an individual return or a single return, and $250,000 on a joint return. So your investment income on returns above that level gets an extra 3.8% tax on that. But still, it's better than your ordinary rates, which right now are anywhere between 10% and the highest rate of 39.6%. So 23.8, much better than 39.6. If you do have long capital gains, whether it be short or long term, and you know you've got them now, you would talk to your investment advisor, see if there's any investments in your portfolio that are currently depreciated and have a loss. You could sell those, and that loss can be used to offset the capital gains that you currently have. And also you can take a net $3,000 capital loss on an annual basis against your other income. So you can actually take a $3,000 capital loss and have it offset your wage income. So now we're going to cover some business tax items here. So first and foremost, we always advise our clients to make sure that they're capturing all of their business expenses. So normally when a client sets up a business, we advise them to create a business bank account, checking account, and make sure they run all of their business income and expenses through that account so that it's easy to figure out, obviously what your net income is and keep track of that, but also you make sure you capture everything. Now, we know in the real world that small businesses, often business owners, maybe they don't have their business check card with them or what have you, but they end up paying expenses out of their personal account or maybe on their personal credit card. So you just want to go back and review all the different ways you pay expenses and make sure that if you did use personal accounts to cover expenses for your business, that you captured all of those. Another item to think about is auto expenses, and you want to make sure that if you use your personal automobile for business purposes, that you capture that as well. You can take a standard mileage rate deduction, which for 2017 is 54 cents per mile, or you can take a percentage of your actual expenses based on your business use versus overall use of the car. So if you use the car 10% of the time for business, then you could take 10% of your insurance, gasoline, maintenance costs, depreciation of the cost, and then you can compare that total to the mileage deduction. You actually get the higher of the two deductions. So make sure you're, don't miss out on your business auto use deduction there. For those of you that have a home office, basically a dedicated space in your home that you use for business on a regular and exclusive basis, and you can get a home office deduction. And basically here you can get a percentage of your home expenses against your business income. So if you use 10% of your home for business use, then you can get 10% of depreciation, so you can depreciate the cost of the home, and 10% of your utilities, maintenance, repairs, and any direct expenses related to your home office. If you buy things, you can get 100% write-off on anything that's direct if you buy furniture, equipment, or incur expenses that directly relate to your office space. But all those general expenses, you get to pick up that percentage and offset it against your business income. The next item is a big one. Right now, the ability to write off new fixed assets is very good. So a couple of years ago, Congress passed, or they put forth regulations that basically stated if you bought a new fixed asset, it cost less than $2,500, that you were allowed to expense that for tax purposes. Under the old rules, you would normally have to capitalize that item and depreciate it over its useful life, normally 5 years for equipment or 7 years for furniture. But basically, the IRS acknowledged that and created this threshold where if you bought assets below a certain dollar amount per item, that you can actually just write them off as an supplies expense or small item expense versus having to actually capitalize them. So if you have old computers, if you have, it's been a good year, you may look at just replacing some of your fixed assets or maybe buying some new ones because you have the ability to write them off. If they cost more than $2,500 per item, you can still have the ability to write them off under Section 179. You can, under that provision, you can write off up to $500,000 worth of new equipment. Now, 179 can't create a loss, so you can basically write off the cost of new assets to get you to break even. You can't write off assets to create a loss to net against other income on your return, but it's good to know that basically, if you need to buy new assets, that there are ways where you can basically get full expensing on them in the current year. We talked about business use of your personal auto already. Retirement plans for small business. If you haven't set up a retirement plan for 2017, some qualified plan like a simple or 401k, something like that, it's too late to do that for 17. But there's a simplified employee pension, otherwise known as a SEP plan, that you can set up anytime during the tax year or even the following tax year up until the time you file your tax return, and you can contribute up to 25% of your net income into that plan, and the ceiling on that is $54,000 for the SEP contribution. So if you don't have a retirement plan now, you can set up a SEP and make a contribution based on your net self-employment earnings up to that 25% of net income, and you can do that up to the extended due date of your tax return. So most small businesses report their income and expenses on the cash basis of accounting. Basically, you report income as you receive it, and you report expenses as you pay them. So to the extent you have some expenses that have come in that you can prepay, maybe they're not due until January or February, but you know what they are now, then you could pay those expenses now and get the deduction in 2017. And also to the extent you could defer maybe sending out an invoice to a client so that you don't receive payment for maybe some December work in December and you receive it instead in January. Deferring income to 2018 is a good strategy to lower your 2017 tax and maybe push that income into a year where if they actually do pass new tax laws with lower rates, you would get taxed at a lower rate on that income. Other ways to reduce income, if you turn 70 and a half this year, this would be the first year you're required to take your required minimum distribution from your qualified retirement plan, your IRA or 401k. But the IRS does allow you to take that first RMD the following tax year before April 1st. So if you haven't taken your first required minimum distribution for 2017, you can actually take it in 2018 before April 1st. Now in 2018, if you did that, you'd actually have two RMDs to take. You'd be taking your 2017 and your 2018 RMD in the same year, but again, maybe our tax rates will be lower then. If you have a rental property, just want to note here, make sure you've captured all of your expenses related to your rental property, whether you have a separate bank account that you normally run things through or a credit card, or just make sure you capture everything there. You can also get auto deductions for your rental property. If you are a partner in a partnership or a shareholder in S-Corp, and the organization, your company, expects that you as a partner or shareholder are going to incur business expenses that they are not going to reimburse, then you can take those expenses to the extent you're not reimbursed for them, against your net K-1 income. So you want to make sure that you don't lose out on that. Finally, you can contribute to your IRA, and the limit on your IRA or your spouse's IRA would be $5,500 normally, and if you're 50 or older, you get to put an extra $1,000, so for a total of $6,500 into your IRA. IRA contributions can be deductible. Generally, if you are a participant in your employer's retirement plan, you probably won't qualify for a deductible IRA. You could still put the money in, but it would be a non-deductible contribution. There are income limits, so your ability to make a deductible contribution phases out depending on your income level, and it phases out at different income levels depending on whether you and your spouse are participants in a qualified plan or not. If neither one of you are, then you can contribute to a deductible IRA, and there's no income limit. Neither one of you are a participant in a qualified plan. You have to have enough earned income to make the contribution, but that's really the only limitation. Okay, so now we've reached our first polling question of the day. So the polling question is, what statement best describes where you currently stand with your 2017 tax planning? A, I have already done my planning for 2017. B, I am interested in planning, but I have not begun the process. Or C, I do not plan on doing anything, but may revisit the issue if there is a law change. So please take a minute and answer the polling question. And I also want to take this time to give you the first CPE word of the day. And our CPE words today are going to be based on what it takes to pass a new tax law, since that's in the news now. So your first CPE word is house. Again, the first CPE word today is house, and you'll need that at the end to get CPE credit. So the polling question has ended, and roughly half of the people didn't answer the question, but about 20% of those who did have already done their planning. About the same number, about 20%, said they're interested in planning, and about the same amount don't plan to do any. So I guess overall, I'd say, the people who have already done it and combined with the people who plan to is fairly low, I guess, given the total. But you may want to look at that if we have tax law changes. You want to change your mind and do some planning before year end. So now I'm going to switch over to David, and he's going to talk about itemized deductions.
Good morning, everyone. This is David Grayling. I'm a partner here at Gelman, Rosenberg Freedman. First, I'm going to talk about itemized deductions, and I'm going to follow up with some information about various tax credits. Itemized deductions that we often see are medical expenses. One of the largest medical expenses we see is the cost of nursing homes. We have many clients that are currently in nursing homes, and they deduct the cost of those nursing homes. And the nursing home normally provides us with a itemized percentage that we can use in order to determine what the medical expense is for the nursing home. The big thing with medical is it's subject to a 10% of adjusted gross income limitation. So whatever your adjusted gross income is, we take 10% of that, and you can deduct everything above that 10%. Another itemized deduction is the taxes area, and there are actually two big taxes that we deduct. One is real estate taxes, and the other one is income taxes. So in both cases, those can be significant deductions. On the income tax area, it's basically based on what you pay during the year. So if you make year-end tax payments to a state, then those deductions are available to you. So oftentimes in doing our tax planning at the end of the year, we'll see whether or not you can deduct those taxes. If you're on the alternative minimum tax, sometimes there's some limitations, but we're always trying to do planning to see whether it makes sense to pay those taxes in the current year or to wait to pay them until the future year. Mortgage interest deductions. There's currently a cap of $1 million on your primary mortgage, and then you can deduct interest on a $100,000 home equity line of credit or home equity loan. So your total cap is $1.1 million, interest on $1.1 million. And there's some proposed changes that Troy's going to cover regarding the mortgage interest expense deduction. On the charitable area, the important thing to remember on the charitable area is you need written support for any contribution greater than $250. And this is really a bright line. The IRS continually wins cases in tax court where a person has donated something of significant value and they've received no acknowledgement of the deduction, and it was greater than $250. So it's very important that you obtain some type of written documentation that you've given that item and it's worth more than $250. Another area in the charitable area is donating stocks. If you have a stock that's appreciated considerably, if you bought a stock, say, for $10, but it's now worth $100 a share, you can donate that stock directly to the charitable organization, and you can receive a deduction for the $100 per share. So many of our clients use this, what we call appreciated stock donation, in order to increase their deduction. And the other nice thing is it does avoid paying capital gains tax on that increase in value. The other major charitable area that we see is donor-advised funds, where a client will put significant amounts of money into a donor-advised fund through, say, a Fidelity or a Vanguard, and they receive the tax deduction for the amount they put in the donor-advised fund during the year, but you don't actually have to contribute the money out of your donor-advised fund in that year, so you can distribute the money at a later date out of the donor-advised fund to various charities. And then finally, the miscellaneous itemized deduction area. This is where you would deduct items such as investment interest, investment expenses, like where if your stockbroker charges you a fee for managing your money. Also, employee business expenses would be deducted here. So the big caveat here is that this area is subject to a floor of 2% of adjusted gross income. So if your adjusted gross income is $100,000, your floor would be $2,000. So oftentimes the expenses don't add up to more than that, so you can kind of ignore this area. But if your expenses add up to more than the 2% floor, then it's valuable that you can get a deduction in this area. So let's move on to credits now. Just talking about some potential tax credits. There are some education credits that are available. There's one called the American Opportunity Credit. This is a maximum credit of $2,500 per student. The one form that we really need for you to provide us as your tax preparer is the Form 1098-T, T as in Tom, and that's normally issued by the college or school that the student is going to. And oftentimes you can pull this down off from an online system at the school. But we really need a 1098-T in order to try to claim this credit. This full credit is available if you're modified adjusted gross income, if you're single, if it's $80,000 or less, or if you're married filing joint, married filing joint return of $160,000 or less for your modified adjusted gross income. And modified adjusted gross income is where you have your adjusted gross income, which we talked about previously under itemized deductions, but you add back certain items such as foreign income, student loan deductions, and IRA deductions. So you'll receive a reduced credit if your income for a single individual is between the $80,000 and $90,000, and for a married filing joint filing income of $160,000 to $180,000. Another credit that's available, education credit, is the lifetime learning credit. This is 20% of $10,000 of qualified education for a maximum credit of $2,000. In this case, the modified adjusted gross income is lower. If you're single, it's between $55,000 and $65,000, and if you're married filing joint, it's the limit is $111,000 for married filing joint returns, and it goes up to $131,000 before the phase out is total. So there are limitations on both of those credits. The child tax credit is a credit which is $1,000 per qualifying child, and there's really no limit to the number of children here. So if you have, let's say, 5 children, you could have a credit of up to $5,000. They do need to be your dependent in most cases, and like as I mentioned earlier, there's income limitations on this credit. So on a married filing joint return, the limitation begins at $110,000 is the limitation. So if you're earning, say, $200,000, or if your adjusted gross income is $200,000, you probably will not receive this credit. The child care tax credit, this is for where you're paying a daycare center or a babysitter or even a summer camp. The important thing here to remember is that you need to report your provider's name, address, Social Security number or employer ID number, and in order to claim this credit. So we need that information in order to claim this credit. The child in this case must be under age 13, and the credit is 35% of expenses up to $3,000 per child, and the maximum credit is $6,000 of eligible expenses. And then if your income is above $43,000, your maximum credit here is 20% of the expenses. So usually the maximum credit that most of our clients can claim is $1,200. So it's $600 per child for a maximum credit of $1,200. The foreign tax credit is you're eligible for it if you have foreign income tax withholding. Normally this will be for mutual funds that you've invested in that are investing overseas. They normally have a small amount of foreign tax withholding. So the IRS website actually says, they have a statement on their website that says the foreign tax credit laws are complex. So that's an understatement there. But we can calculate this credit for you as part of the tax preparation. The other important thing in the foreign tax credit area is not to forget about filing FBAR FBAR filings. This is the foreign bank account reporting statement, and this is filed with your tax return now. It used to have a June 30 deadline, but now it's with your individual income tax return. So if you have a foreign bank account overseas and you're a signator, if you're a signator on that bank account, or if you own the account outright, then it's very important that you file the proper forms, because there are significant penalties for violations of that, not filing the foreign bank accounting reporting forms. And finally, there is a credit for electric plug-in vehicles. The IRS credit is between $2,500 and $7,500, depending on the vehicle. In addition, there are significant state incentives available for an electric plug-in vehicle, and we can advise you about those state incentives as well. I just wanted to talk about the 2017 tax rates just for a second. We've listed them in this chart. So as Troy mentioned earlier, the rates go from 10% up to 39.6%. And you can see the various threshold or the various categories of filing: single, head of household, married filing jointly, and surviving spouses, and married filing separately. So I'd like to go to polling question number 2. Polling question number 2 is, if you knew the tax savings involved with incurring additional itemized deductions, such as prepaying state taxes, accelerating elective medical procedures, or donating to charity, would you be more interested in implementing these strategies? So the answers are: A, if I knew I would save money, I would definitely act. B, the savings would have to be high to get me to pay an expense in advance. And C, no level of savings would affect my willingness to pay before an expense is due. So if you can just take a moment to answer those questions there, A, B, or C. And I'll mention the second polling question, the second CPE word. So the second CPE word for today is the Senate, which is with the deliberative body that the tax bill moves to once it goes past the House. So I'm going to turn it back over to Troy now, who's going to talk about current tax proposals.
Okay. So before I cover that, I just want to note the response to the polling question. It looks like a good percentage of you would be interested in doing a little planning around additional deductions if you knew how much money you were going to save by doing them. So that's good. Okay, I'm sure everyone has been hearing in the news all the different proposals that are out there. It seems like they've been talking about potentially changing the tax laws all year now. We've been certainly waiting for something to happen on our end, and thought by this seminar that we'd be able to tell you all the new and exciting laws that have passed and are in place, and be able to do some planning. Unfortunately, all we could do now is just kind of tell you what's out there, what the proposals are. Of course, none of these things are written in stone. The House has introduced a bill, and the Senate has introduced a plan. But neither one of those bodies have actually voted on anything yet. And I expect that and both of their proposals are different. So when I go through here, where there's a proposal that's different, I will note where the Senate is different. So the initial item that's bulleted here will be the House bill under the Tax Cuts and Jobs Act, and then in parentheses, if the Senate has a different provision on that item, then it'll be noted there as to what the Senate's idea is. And then ultimately, both bodies will have to come together and agree upon what the actual revision change will be, so that they could pass the ultimate law through both houses and then send it to the president for signature. So the first one is tax rates. So both bodies are looking to change the tax rates. So David just showed you our current rate structure. Under the House plan, they're looking to go to a 12%, a 25, a 35, and they're keeping the highest rate at 39.6. The Senate has more rates. They basically have introduced a 12%. They've basically kind of tweaked a lot of the rates that are currently there. So they've kept the 10, they've reduced the 15 to 12, they've reduced the 25 to 22.5, the 28 to 25. So you can see how they've kind of adjusted them all. And at the very top bracket, they've reduced it by 1%. Neither one of the proposals have changed the tax rates I discussed earlier on long-term capital gains. So those are still in play. Under the proposals, both proposals, they're looking to eliminate your personal and dependency exemptions, but in exchange for getting rid of those exemptions, they're both proposing to increase your standard deduction. So they're roughly, the standard deduction for a single return is looking to go from $6,500 roughly on a single return to $12,000. If you are a single person with a dependent child, then that would be $18,000. And on a joint return, it's $24,000. Now, I think one of the provisions is, a few $100 different than the other, but roughly this is where they both are. They're in the same ballpark, 12, 18, and 24. So that's your standard deduction for those who are not itemizing. Or if your itemized deductions fall below that threshold, you obviously wouldn't itemize, you take the standard. The child tax credit that David spoke about earlier that was currently $1,000 per child, and he mentioned those phase-out levels. Under both provisions, the child tax credit would, under the House provision, increase to $1,600 per child, and under the Senate version, $1,650. And they both have introduced a new provision where if you have a dependent that's not a child, say a dependent parent, you could get a credit for $300 under the House provision and $500 on the Senate provision. And the phase-out levels are higher under both provisions. So this is where I think you'll see the most impact is people that couldn't take the credit because their income was too high before. Under both plans, they've increased those limits. You see the phase out for the House is $115 on a single return, $230 on a joint return, and the Senate version is very generous. It's $500K on a single return and $1 million is the phase out of the child tax credit under the Senate proposal. So also under individual proposals, we have the House has proposed that you'd lose some various credits, including the electric plug-in one that David spoke about, the lifetime learning credit, and the adoption credit. The Senate version keeps the adoption credit. Under the House provision, you would lose the ability to deduct student loan interest. Right now you can deduct up to $2,500 in student loan interest. And your ability to do that phases out. There's also a tuition deduction that's currently $4,000. That would disappear. There's a phase out on that also currently. So you may not, but it's higher than the credits. So some people who couldn't get a credit currently could get the deduction. That provision is slated to go away. And right now your employer can actually cover college tuition costs for their employee up to $5,250 worth of tuition expenses, and it not be taxable compensation on your W-2. Your ability to get that benefit from your employer tax-free would go away under the House provision. So all those provisions are would go away under the House provision. The Senate would keep them all. They would not change any of those. A big deal under both provisions is the repeal of the alternative minimum tax. So basically when we do your tax calculation, we calculate it under the regular method, which you get to utilize all the rates that we mentioned. Under AMT, you lose certain deductions and you're taxed at a flat 28%, and you basically pay whatever the higher result is. So they're looking at getting rid of the AMT tax, which a lot of our clients are in that, so that's a very good idea, and they've been talking about doing that for a long time. On the deduction side, the mortgage interest under the house plan, you'd lose your ability to deduct interest on your home equity line or your home equity loan. You would also lose the ability to deduct interest on a second home. So you currently can deduct interest on 2 homes up to the cap of 1.1 million of total debt. Both of those homes under the house plan, no second home, no home equity line, and your cap on your primary residence is a $500,000 loan. So you can deduct interest on 1 loan up to $500,000. Under the Senate plan, they allow you to deduct interest on a second home, and the limit's still $1 million combined between your 2 houses. But the only thing they really do is get rid of that ability to deduct the interest on that $100,000 home equity line. So the Senate's obviously much better on the home mortgage interest side than the House is. Both provisions would get rid of your state income tax deduction. Under the House plan, you would still be able to deduct your real estate taxes up to $10,000 total. And as best I can tell, that would be on multiple properties, but you have a $10,000 ceiling on all properties. On the Senate version, no real estate tax deduction. So no state taxes at all. That would include sales taxes as well. Under the House plan, you lose some of your 2% miscellaneous itemized deductions that David spoke of, your tax prep fees, employee expenses. Under the Senate plan, you lose all 2% miscellaneous itemized deductions. Here's a big one. Medical deductions would be completely gone under the House plan. A lot of our clients don't get them because you have to exceed 10% of your AGI to begin to deduct medical costs. But for older clients, especially those that may be in a nursing home and have a lot of medical expenses, this would be very detrimental to them. Under the Senate plan, they're keeping the medical deduction. So let's see, under the House plan, you lose your ability to deduct alimony payments. The Senate keeps that deduction. Under the House plan, you lose the ability to deduct qualified moving expenses. So when you change jobs right now, you can deduct moving expenses for a job change. You also can be reimbursed tax-free by your employer for those qualified expenses if they pay them for you. That tax-free reimbursement will go away. You wouldn't be able to deduct moving expenses either, and that's the same under both plans. Under the House plan, you wouldn't be able to do that $5,000 dependent care flexible spending account that I spoke of earlier. The Senate does not change that, so you would still be able to do it under the Senate plan. Big deal under both plans is that right now you can exclude the gain on the sale of your principal residence. So on a single return, you can exclude up to $250,000 in gain. On the joint return, that ceiling is $500,000 in gain on the sale of your principal residence. And to qualify for that, you have to own and use the property for 2 out of the previous 5 years. Under both plans, you have to use your home to get that exclusion 5 out of the previous 8 years. You have to own and use it. So they've really increased that threshold to be able, the qualifying threshold to be able to use to get that exclusion. And also under the House plan, they eliminate the exclusion altogether for high income taxpayers, dollar for dollar. Once your AGI is above $500,000, then you'd lose your exclusion dollar for dollar until. So on a joint return at $1 million of AGI, if you had a gain from the sale of your personal residence, you'd have to pay tax on all the gain. You'd have no exclusion left at that point. State and gift tax, right now, each person has about a $5.5 million lifetime estate and gift exemption where you don't pay estate or gift tax on up to $5.5 million of your estate. Both plans roughly double that to $10 million per taxpayer. Under the House plan, they would repeal the estate and gift tax altogether in 2023. Under the Senate plan, there would be no repeal. They just would be increasing the limits. Under the Senate plan, they would remove that additional $6,000 catch-up contribution to your 401k and 403b that I mentioned earlier in the wage section. The House plan doesn't affect your 401k or 403b contributions at all, but under the Senate plan, they would eliminate your ability to make that additional $6,000 contribution. So there's quite a few business provisions as well. One of the highly publicized one is lowering the corporate tax rate from 35% to 20%. So under the House plan, they would, and Senate plan, they both would do that. Under the House plan, they would also have a 25% flat rate for personal service corps. Under the Senate plan, there would be no separate personal service corp rate. The currently we have the 35% flat tax rate on personal service corps. Under both plans, they are looking to reduce the net income on pass-through entities. So that would, the way that works under the House plan is you'd have a maximum 25% tax rate on pass-through income from partnerships or S corporations. Unfortunately, you can't get a 25% on all of it. The way the standard calculation allows you to only get that rate on 30% of the net income. You can choose an alternative method to figure out what that percentage is. If you can defend that, a higher percentage, they will allow you to do that. Under the Senate plan, they don't deal with it as a maximum tax rate, but they basically have created a deduction of up to 7.4% of your net income. So they've kind of created a fictitious deduction against your pass-through income. That's 7.4% of that. Let's see, I'm going to kind of speed up here. Expensing of assets, so we already covered that. And there already are generous expensing rules, but under both provisions, they allow you to write off all of your assets without using 179, although they've increased those limits from 500,000 to 5 million under the House plan and $1 million under the Senate plan. But you could basically expense every fixed asset you bought that wasn't a building or land in the next 5 years under both plans. For C Corps that want to use the cash basis of accounting, right now, if your income's over 5 million, you generally have to switch to accrual. So they've increased those thresholds to, under the House plan to 25 million and 15 million, respectively. So you have greater ability to use the cash basis of accounting, which provides more flexibility. For C Corps, they've limited your ability to deduct interest expense, so that's listed here. They've also affected NOL carryovers and carrybacks. So under both plans, they get rid of the carryback, which is currently 2 years, and the carry forward would basically be limited 90% of your net income. And there's some other business provisions here that I've mentioned that I've kind of listed out. I think one of the big ones is repealing corporate alternative tax. And then there's some other ones here that you can peruse, but I want to get to our polling question. I also want to mention that I basically have picked out some of the more popular provisions on the individual and business side. There's many more tweaks that they proposed to the laws, but we just don't have time to get into them. These were the ones I felt like had would have the biggest impact on the most people. So those are the ones that are mentioned. Okay, so we're back to our last polling question of the day, and that is, what statement best describes how tax laws impact your behavior? A, very much. I operate at a business and personal level with the potential tax outcome at the forefront of my mind. B, I only think about tax impact for significant monetary events. Or C, there are only two certainties in life, death and taxes. Why worry about them? So please take a second and answer our last polling question. While you do that, I'll give you our last CPE word of the day, which is president. Again, the last CPE word of the day is president. So I've got the results here from the polling question, and as everyone can see, that most people, which is not surprising, really only think about taxes when they have a major event in their life, probably when they're selling their home or something like that. So that's what I expected to be the most popular response. There are a few tax geeks out there that think about taxes constantly. So that's interesting, but as well. Let's see. So now we've got to the question and answer section of our program. So I want to please submit a question, and David and I will do our best to answer it. We've got about 10 minutes to cover questions. So David, do you want to go ahead and take the first one?
Yes, Troy, I'll go ahead and take the first one. So someone's written a question. I have a used car that I want to give away. What are the rules related to car donations? So several years ago, the IRS kind of cracked down on this whole area. There's kind of a couple different determining factors. One is that if the thing's a real clunker, you're allowed a deduction of $500 no matter what the value of it is. So if it's basically just four tires on a frame, then you can deduct $500. If the organization auctions the car off, they'll provide you with a form that gives you the value that the car was auctioned off for. So then we can use that value in the tax return, and the organization will provide that to you. The other thing, if the organization actually uses the automobile in their business, then you can deduct the blue book value of the automobile. Really, in all cases, you need to get some support from the organization you donated the automobile to in order to give us the documentation to claim the deduction. So, Troy, I'll turn it back over to you for the other questions.
Okay. I see I've got one here related to tax rates. Someone's asked, most of the tax rates are being proposed are similar to the ones that are currently in place. So am I really going to save taxes based on these rates? And I don't have it in the slide, but I do think that based on the rates themselves, that if you're a person that is taking the higher standard deduction, so you're not losing itemized deductions such as the state income tax or real estate tax or maybe some your mortgage interest, if you're just kind of getting most of the changes in the rates, then I think you will see a reduction in your overall tax burden, because the rates, while in general are similar, where they basically move those lower brackets upwards. So, for example, in the House proposal, that lowest 12% bracket is on the first $90,000 of income, taxable income, on a joint return. So yes, I think that based on the rates where they've cut them off, they have kind of shifted the brackets up, and even the top rate used to kick in around $450,000, and now on a joint return, and now it kicks in at $1 million under both plans. So the rates do help. It's just that where they give it, they take it away, and that's in the deduction side. So if you get better rates, then if you're losing a lot of deductions, and people in Maryland do pay a lot of state income tax in our area. So if you lose that deduction, then the rate savings, you may still end up with an overall tax increase. It really depends on your individual circumstances, but the rates themselves are better. Let's see. So I have a question here. It says, you didn't mention the Roth IRA. Can I contribute to a Roth and save on taxes? So that's a good question. But unfortunately, I mean, the Roth is a really good plan in the end, but the amount that you contribute to your Roth IRA, which generally have the same limits as your traditional IRA I mentioned before, $5,500 and the extra $1,000 for somebody 50 and over. There's no deduction for the contribution, but all earnings that come out at retirement are tax-free. So that's the benefit of the Roth. Is at the back end, all your income all the appreciation in that account comes out tax-free. But there is no benefit for the deduction. There's no upfront tax benefit, and there's also a phase-out for your ability to take a Roth deduction. So not everybody can do it. Let's see. I've got a question here on when you get the tax deduction on if you contribute to a donor-advised fund. So, David, you want to take that one?
Sure, Troy. So in a donor-advised fund, it's when you make the contribution to the donor-advised fund is when you can take the tax deduction. So as I mentioned, the donor-advised fund does not have to distribute the money to the charity, but and it can sit in the donor-advised fund, but it's when you make the contributions to the donor-advised fund.
Great, thank you for that. Let's see, we have a question here that asks if there's any changes contemplated for the solo 401k or that SEP plan I mentioned earlier, the Simplified Employee Pension Plan. So on the 401k side, if the Senate plan passes, if they get their way and they reduce your ability to make that additional $6,000 catch-up contribution to your 401k account, then that would also affect the amount you could put in your solo 401k. It would be reduced by $6,000 for those people who are 50 and over. That's the only change I see related to either one of those plans. Let's see. There's a question here asking if either of the tax reform bills mention changing the rules related to backdoor Roth IRAs. There is a provision in the House bill that talks about being able to recharacterize contributions. So if you make a Roth contribution and your income's too high, so you want to recharacterize that to a traditional IRA, they have proposed to eliminate your ability to do recharacterizations. So I had not seen anything related to actual conversions though on the Roth. So that's the recharacterization issue is a little different than doing the backdoor Roth. So I have to say I haven't read anything specifically about that, but there's a lot of details there that so I'm not sure if I caught that one or not. But I know there is something related to recharacterization. So we do have a question that asks what classifies a company as a personal service corp. And generally your personal service corps are businesses that specialize in accounting, law, medical, consulting. So architecture, so your standard service industry, professional service industry classifications are generally your engineering. Those are the types of entities that would be classified as a personal service corp and currently be subject to that flat 35% tax rate. Whereas under the proposals in front of us, that'd be cut 10% under the House bill to a flat 25% rate. And then under the Senate plan, they don't have a separate rate. So personal service corps would get a big boost, from the flat 35 down to a flat 20%. So no penalty under the Senate plan for personal service corps. So those are all the questions that have come in. If anyone has a last-minute question they want to try to sneak in before, we have roughly, a minute and a half left of the seminar. Otherwise, I want to thank everybody for listening in today and participating in the seminar. We really appreciate you sitting in on it. We encourage you to get in touch with us. You see David and I's contact information. If you have a question you didn't think of, it comes to you after the seminar, be happy to take a few minutes to answer it if you want to shoot me an email. Otherwise, get a hold of the firm. Again, if you want that CPE credit, please answer the pop-up that comes there and put those 3 words that we gave you related to the getting your credit. So again, thank you very much.